For that, we're going to bring in Stuart Kaiser, who's made his way to the desk over here. He's Citi's head of equity trading strategy. You've heard the banter so far. It's got to be akin maybe to what your discussions are like on the trading desk right now about just the push and pull in the market, is it not?
Yeah, I mean, I think you hit it right there. It's a push and pull. It's the positives from lower inflation and a positive GDP revision get offset by 50 basis points less of hikes. And I think tactically speaking, the rates are what drove the market lower today. But I think if you're an equity investor, you're looking a couple weeks or months out, then that positive growth outlook has to be, what you're more focused on. And you have to take the view that if equities are strong but growth starts to weaken, that the Fed ultimately is going to not be as stern as they've been recently. We've had a lot of clients tell us, it's easy for the Fed to talk hawkish when the job market looks like this. Show a little weakness to the job market, and let's see if they change their vocabulary a bit.
Is there any expectation that you could see weakness in the job market? There's been talk about it for maybe a year at this point.
Look, I mean, you had the JOLTS report a few weeks ago. That showed some loosening, but that was quickly followed up by what I would call a pretty strong non-farm payrolls report. So, no, there's no clue of it yet. Some folks would say, well, the strikes, and then you get Amazon telling you they're going to hire 250,000 new employees. We're not seeing any weakness in the labor market. I think if you are seeing any cracks on the labor/consumer side, it would be more on the credit card spending side. Our credit card data does show lower spending. A lot of the retailers talked about higher delinquencies. So, is that a canary in the coal mine? We'll see, but that's certainly something folks are focused on.
So, Stuart, you talk to obviously a lot of very smart investors who are moving very large pools of capital around the market. What do you make of just the level, I think, of complacency? You just heard me say, I think under the hood there's some cracks that are starting to happen here a little bit. But I was like, the one thing when I was listening to this presser today, I was looking at some of these high growth tech stocks sell off really hard. I went to the options market, I looked at the QQQ, and I looked at the next Friday, the 29th, 7 trading days from now, and they cost me 1% of the ETF price. That seems really cheap, especially when you have all. So talk to me about like the level of complacency and what the market is pricing, because I bought those. I'm like, you know what? I'll sit on those for a week and see how I do.
Look, I think year to date, you've been rewarded for sort of just embracing the good news, right? Why are yields and equities higher the last year? Because economic growth data has massively surprised consensus expectations over that window. I think what you've seen the last 2 to 4 weeks is that started to shift a little bit, right? The growth isn't beating by as much. Yields are rising for less good reasons, and you're starting to get some pressure. But look, anybody who's faded tech this year has ultimately regretted it, and I think that's why you see a lot of upside still priced into that space. And the last thing I would say is scarcity. Frankly, there's a scarcity of large cap growth stocks and also a scarcity of positive consensus revisions. So if you can find stocks that have that, people are kind of reluctant to walk away from them.
So, Stuart, let me ask you something about labor. So we never expected to have an unemployment level of this low and sustained. Does that take away some of the room that the Fed has? What's considered an acceptable reversal in labor markets before they need to sort of turn dovish?
I mean, it's a great question, because if you took the message at Jackson Hole, I think Chair Powell was reminding folks that, hey, we're willing to pay a growth price to make sure inflation comes in, right? Today, though, they revised up the growth number. So, look, acceptable. I think, the Fed has messaged pretty consistently that, if we create some job losses and that's the cost of inflation lower, then they're going to do that. Whether they follow through on it when the data appears, I think is the ultimate question, right? On our view, a soft landing, and in this case, I mean a non-recessionary growth slowdown, would mean your unemployment rate stays below 4.5%. If you get a recession, it's sort of above 4.5%. So I think that's kind of a Mason-Dixon line for us.
And Stuart, before we let you go, what do you think? What's your favorite spot to be in, given that backdrop?
Yeah, look, gun to our head, we're still, positive on equities. I still think there's a window here where once the markets digest the move higher in rates, they're going to reorient themselves to the positive growth stuff. I mentioned scarcity in tech. It's an area that we still like. I would say the caveat here, though, as mentioned earlier, is higher rates, eat on tech a lot more than they eat on other spots. And you might argue that the higher rates with the positive growth impulse, might warm you up to cyclicals a little bit. It's been very narrow leadership. So if we get a broadening in leadership, I think quite positive.